Okay, next up is Jordan's question. It says, can you explain the difference between Roth and after tax? Isn't Roth taken after taxes? What's the difference? Yeah, this is a good question.
You know, this is really interesting vocabulary because sometimes we will talk about step 7 of the financial order of operations. If you don't know what that is, you can go to moneyguy.com/resources, step 7. And we talk about you might want to start saving in your after-tax bucket. That's language that we use. Now, we've tried to get better about not calling it your after-tax bucket and calling it your taxable bucket so as not to be confusing. Because another piece of language we use is when we talk about 401k contributions and folks that can do the mega backdoor Roth, we talk about how there are 3 different ways that you can put money into your 401k, or 3 different ways that some people can. You can do pre-tax, you can do Roth, or you can do after-tax. So it's confusing when you talk about this after tax as it relates to 401ks and also talk about step 7 taxable brokerage account as after tax. So we're going to first discern that those are 2 different things, right? Now, I think what his real question is not about the after tax brokerage account. I just thought it was worth addressing. His real question is, when it comes to like 401k and thinking about that, what's the difference in the after tax dollars that you're talking about? And what's the difference in Roth dollars? Because aren't Roth also indeed after tax? And then maybe he's talking about Roth IRAs versus after tax brokerage, and you can speak to that too. Yeah. But that's the question, I think.
Well, I think if you're putting this in some priority, Roth is a legal thing set up by legislation. Our government set up where these are heavily tax favored accounts to the point that they put income limits as well as annual contribution limits. So when you're thinking about in terms of Roth contributions, that's somebody who's trying to load up the designated contributions you can make to these legal setup accounts, these tax-free growing, or they grow tax-deferred, but if you actually use them for retirement, you get to make withdrawals completely tax-free, which is super powerful. But you're limited. Like in 2023, those under 50, it's $22,500. Now, I'll give this both ways, is that in 401ks, I've talked about this earlier with the mega Roth conversions. If you have an employer who's very proactive in the structure of their retirement plan and they create mega backdoor Roth contributions, that means they have 3 baskets. They have the pre-tax, they have the Roth, and then they have the after-tax. And you can fund all the way up to $66,000. That's the employer, the employee, and then the after-tax, which is still you, but it's just got a different designation.
It's not a salary deferral, technically.
Right, it's not a salary deferral anymore. That you can take that all the way up to the full $66,000, and then through structure of doing conversions, you can actually turn that into Roth accounts where they grow tax-free. Now, if you're trying to say the other side of this, because it's all about the language of the way the question was asked, what's the difference in step 7 between the Roth and after tax, meaning a taxable brokerage account? It's back to what Bo said. First, you have to do the Roth is the tax favored set up by the government with all those limitations of who gets to do it. You're going to want to maximize that. That's why it's a step 5 of the financial order of operations, is because we want to take advantage of all the things our favorite taxing Uncle Sam is giving us. But then I love taxable brokerage accounts in step 7 of the financial order of operations because it allows you to have easy, unlimited access. Plus, there's some tax-favored stuff with your interest and your dividends. That's why it's nice to have all 3 pots of money kind of harnessed so you can legally manipulate how you get access to your money in retirement.
I love it. Katie, I'm going to try to give you a really quick, easy little sound bite right here. Are you ready for this? All right, pre-tax, money goes in, you get a tax deduction. Your dollars grow tax-deferred. When you pull them out, you pay taxes. Roth, you get no tax benefit. No tax benefit this year. The dollars grow tax deferred. When you pull them out, they are tax free. After tax 401k contributions, you do not get a tax benefit this year. The dollars grow tax deferred. When you pull them out, you then pay tax. After tax brokerage or taxable investment account, you pay tax every year as the dollars grow.